another episode of Game of Investing podcast. We are going to discuss a business as usual and delve into some of the finer details of this business, understand why they're fundamentally strong, what are they doing right, what this business is doing wrong, and from a valuation standpoint, with respect to the investing standpoint, how the company is trading at, all of that we are going to get into. Now, before I start, none of this should be construed as an investment advice. These are just learnings and discussions around businesses. So that's what Game of Investing series is all about. So in the series, first, we're going to talk about a company which is Warren Buffett's favorite company called Disney. We all are aware of Disney, and Warren Buffett calls this as a wonderful business. He missed buying, or he sold too early in 1960s. He repents for that time and again. And this is a wonderful business, and he loves the CEO, Bob Iger, who left the company, and Disney stock took a beating in the late 2020 and 2019-20, and Bob Iger has come back to turn around the company, which is a great news. Now, why did I take Disney? Because Disney is at a very interesting cusp or inflection point today. It is trading on a 10-year basis. It is trading at the lowest valuation possible on a 10-year basis, historical average standpoint. Disney is a capital intensive business. It has a lot of parks, as we know. It has a lot of theme parks, resorts. It has a streaming business, which is the second leg of business, which is again capital intensive. The third business is linear TV and broadcasting. Now, the first leg of the business, which is the theme parks, the parks and resorts. Now, this is very capital intensive business. They are all assets. They can be called assets, right? So here are what you're going to learn about different businesses, how to look at businesses from a valuation standpoint, right? That's what I'm going to teach here. Now, Disney has a lot of assets that we can call these as assets, like parks are assets. These are real physical assets. Then streaming business, IP, content, licensing, all those are assets because they can only be bought or acquired. There are businesses that Disney holds in through acquisitions, whether it is Marvel, 21st Century Fox, many other streaming companies, ABCs and of the world. All of them Disney had acquired. So they also carry a cost. These are all assets, the broadcasting stations, these are all physical assets out there. So according to me, Disney should be looked at always as a company with a lot of asset, and you should look at the book value. What is book value? The assets minus liabilities on the balance sheet. So the book value of the company should be looked at when it comes to valuation, or even otherwise, you can also look at the earnings standpoint, right? But book value of Disney is at a depressed level today. It was always trading on a historical basis at a 2.6 times book. Today it's trading at 50% marked down. That is, it is trading at 1.3 times book. And Disney had started streaming business, in like 2018, 2019 timeframe. But when it comes to 2013, even then, Disney was trading at 2.6 times book. Many businesses have come into the balance sheet. Disney has acquired many streaming businesses, many titles, many content, but it is at the depressed valuation for whatever reason I'll explain later. Disney is also trading at a historical PE valuation basis slightly lower than the historical average, which was 17. So Disney is always traded at 17 to 20 times earnings. Today it's trading at 64 times earnings. This is because pre-pandemic, Disney's earnings per share was roughly $8. Today it is at $1.4. So the earnings per share has been depressed due to multiple reasons, whether it is when it comes to Disney, the theme parks were closed during pandemic. That hit their business. The EPS was down. Then they have almost 4 or 5 parks in Asia, which are all closed when China went into lockdown, and Japan had an extended lockdown. Now they are all reopening, so the earnings is going to come back. The earnings per share is going to increase. We will get into all those discussions. The book value is going to increase, which is going to have a significant impact on Disney's stock price. Now, let's understand the business segments of Disney. The first segment is theme parks. Disney has parks and resorts, right? They have almost 4 parks in Asia, which is in Hong Kong, one in China, Shanghai, couple of them in Tokyo, right? They have 4 parks in Asia. They have 1 in France. They have 6 in US. So they have so many parks. Now, Disney, with Bob Iger coming back, his focus is 2 to 3 pronged. The first one is the focus on expanding the parks. Their target is to put a capex outlay of close to $60 billion for the next 10 years to double the number of theme parks they have. So that means they're going to have almost 22 theme parks out there globally. Their focus region is Asia, which is the high growth region, with China, India growing like leaps and bounds. Now, that's one focus they have. So they're going to focus extremely on the theme parks business, because Bob Iger calls the parks as a wonderful business. Even Warren Buffett calls it as a high competitive, high moat business. Why is it a high moat business? Buffett says this, like Disney, just like Apple, he said about when he bought Apple stocks in 2016. He says this. He said in 1990s, Disney has a significant mind share when it comes to children and their parents. Every parent would want to take their children at least once or twice to Disneyland. This was told by Buffett, and I think it applies to their streaming business as well. The titles they have, the content they have, are all very have a significant mind share of children, whether it is Marvel characters, 5,000 characters they have, including Avengers of the world, and whether it is the legacy characters of Disneyland with Mickey Mouse and others. All of them have significant mind share still in children's mind share, and that's a significant moat we are talking about. And when they open these number of parks in the future, they could literally expand these parks to much bigger size, more rides, more adventure rides, more pricing, and they could come up with more resorts to stay, and all of that is going to be significant tailwind for the revenue growth for Disney the next 10 years. That is one part of the business. The second part of the business is streaming. They started streaming business in 2018-19 time frame, and they have been doing good. They have been growing well. Disney Parks business is growing roughly 6% revenue basis. The streaming business is roughly growing 12 to 15%. Now, the linear TV is coming to a dead end. We all know that, right? They have the different networks and broadcasting stations like the ABCs or the ESPNs of the world. Erstwhile, ESPNs and ABCs were a cash cow, because that was a brilliant business out there in 1990s, 2000s, and ESPN was literally a cash cow. The cash flows from ESPN were used to acquire many businesses that Disney acquired, including the 21st Century Fox, including the Marvel Studios, many other acquisitions they did. Now, the linear TV is coming to a dead end because the world is shifting to streaming. Everyone is moving into the streaming business, and streaming itself is going through a radical shift when it comes to, they are going away from a pure subscription based model that Netflix innovated. It's all moving into a hybrid model, which is a combination of subscription based video on demand, SVOD, plus advertising based video on demand, AVOD. It's a hybrid model, which means not only subscription going to exist, they are also going to have ad tier or advertising tier, which will be priced accordingly. So Disney's also already, when they started right with a hybrid model of advertising based streaming tier as well. Now, Disney might look at optimizing their streaming business by acquiring more titles, getting rid of titles which are non-performing. Bob Iger is already in the process of doing that. They already got rid of many non-performing titles in 2022-23, and they almost got $5 billion into the balance sheet. They saved $5 billion, which they might use it to acquire more performing titles. For example, Mattel, right? Mattel is a company that has Barbie characters. Barbie has done extremely well in 22-23 gross at box office. They might acquire the business from Mattel. Probably they might acquire Mattel. It's today trading at $7 billion valuation. Mattel is valued there, and Disney might acquire, right? They have the cash from non-performing titles. They could acquire Mattel. Or maybe other interesting characters, or maybe other interesting titles they might acquire. But the streaming business is a key focus area. They're going to put close to $60 billion over the next 2 to 3 years into the streaming business, in acquiring more titles, in producing more movies and all of that. And so the next 10 years, you're looking at close to quadrupling the bottom line. What do I mean? They're going to pay off the debt. The debt today is $44 billion outstanding. They might sell ESPN, which is a linear TV model, the broadcasting. They could get some cash from that. They could put, that cash into paying off the debt, which could aid the bottom line, right? Which could bring the bottom line or the net profits back to what it was pre-pandemic. The theme parks have reopened. Resorts are full-fledged. China has reopened since this year. So that all can aid to the cash flow. That all can aid to the bottom line. So EPS could literally go back to the levels which it was almost $8, $10 per share pre-pandemic. And that could have a significant PE re-rating or price to earnings multiple re-rating, the book value can increase. How? Book values, we know that it's assets minus liability. So when the liabilities are paired off, the book value will increase. Now, if the earnings increases over the next 4 to 5 years, if it doubles at least in the next 5 years, that is going to flow to the bottom line, and that is going to be added back to the retained earnings, which will increase the book value and the reserves. So that is going to help Disney increase the book value, whether it is pairing off debt, whether it is selling off non-performing titles, whether it is cost optimization cash flow, whether it is the selling of assets like the ESPNs of the world or the ABCs. They are already talking about selling ABC broadcasting. All of this is going to increase the asset value or increase the balance sheet, strengthen the balance sheet, at the same time increasing the book value. Book value could be, you could be looking at doubling the book value from the current levels, which means if they double the book value and the book value, price to book value, which is currently 50% down, if that doubles, you're looking at the stock re-rating by almost 4 times. Now, I have a framework in Game of Investing, my course. I have a framework which is 3-pillared framework, like asset-based underpricing or asset-based value, earnings-based value, and hyper-growth-based value. Disney falls in the first category today. It is asset-based underpricing by the market. It is a value investing, typical value investing story out there, underpriced by the market for whatever reason. And earnings, we don't know. It could be a compounder in the future. Today it's only growing at 10-12%, but if they do all of the things I spoke about, the earnings per share could very well compound at 18-20%. Possibilities there. Now they could go do brilliant acquisitions. They could do many other things to increase the streaming business. Streaming business is could be a high growth business in the future, and with them shifting into they having the advertising video on demand plus subscription video on demand combination, it could be a good growth business in the future. Today we are talking about muted advertising, tepid growth because of the market conditions. Now that could change as well. Having said that, it's not a hyper growth story, so let's remove that pillar of the framework, but these two pretty much applies, but mainly it is an asset based, typical Benjamin Graham kind of value play, and whatever earnings compound, that's a bonus, right? So that's what I wanted to bring in this episode of Game of Investing. I will bring in more companies in future. I will have a separate podcast out there in Spotify and Apple Podcast too. So tune there as well, and subscribe to this episode, to this podcast in YouTube for more such interesting business studies. Thanks for staying with me. Signing off, Sandeep Anand.